Hello, and welcome to Cutting Through the Noise, a weekly investment brief brought to you by Signature FD, where we bring you our analysis of the economic landscape and decode market data to help inform you about what to pay attention to in the week ahead. I'm Nick Amat, Senior Portfolio Designer, filling in for Tony Welch, CIO, who is out on sabbatical. Last week's cooling inflation data has been followed by additional signs of softening in the labor and housing markets. Jobless claims have fallen by 5,000 to 238,000, slightly higher than anticipated. Although this represents a decline from the previous week, the 4-week moving average of claims has risen by about 8% since February. This uptick suggests a softening in the labor market, which could lead the Federal Reserve to considering cutting interest rates sooner than expected. In the housing sector, we observed a decline in both housing starts and building permits in May. Housing starts fell by 5.5% month over month and 19.3% year over year, while building permits saw a 3.8% decline month over month. Despite the ongoing housing shortage, construction activity is slowing, impacted by higher borrowing costs, labor shortages, and supply chain issues. The combination of last week's softening inflation data and the current moderate unemployment levels bodes well for a potential rate cut from the Fed. However, it's crucial to recognize that the stock market strength is not solely dependent on rate cuts this year. Most major U.S. equity indexes are hovering near all-time highs, with large cap growth stocks regaining their prominence. Yet there has been some deterioration in market breadth. Despite a slowing momentum, market fundamentals remain strong, with the consumer spending elevated and consumer sentiment at its lowest level since October 2023. As we look ahead, the market will largely hinge on earnings growth. Analysts remain optimistic, projecting the S&P 500 to report its highest year-over-year earnings growth since Q1 2022 at 9% for Q2 2024. Broader growth is expected in the second quarter. Valuations remain high in the short term, and the spread between the consumer price index and the producer price index has reached 0.89%, its lowest level since February 2023. This positive spread indicates higher profit margins as consumers continue to pay higher prices for goods. We recommend approaching high valuations with caution unless there's supporting evidence. Despite these positive trends, it's essential to maintain a balanced and well-informed investment strategy. Looking forward to next week, we'll have data that tells us a little bit about the consumer confidence for May, new home sales in May, the initial jobless claims for the week of June 22nd, the second revision of Q1 GDP, as well as May PCE. Thank you for joining us today. We look forward to providing you with further insights in our next webcast.